lot of the information that you find out there about life insurance is inaccurate or incomplete at best. And today's video, I'm going to do a very short kind of whole life insurance 101 and talk about where it stacks up in relation to other types of insurance and other financial tools. So let's jump into this. Whole life insurance. As you're probably aware, just like term insurance, you have to qualify for it with your health and your wealth. So life insurance is there to replace your income if you, in the case of premature death. Whole life insurance, as opposed to term insurance, however, have a few other benefits where it builds a cash value and also has things like accelerated death benefits and disability waiver of premium. So in the case that you're disabled, premiums can continue to be paid so that your life insurance grows to what it was supposed to grow to no matter what. And then it also has chronic illness and terminal illness riders that allow you to access that death benefit in the case of a chronic or terminal illness. So there are a few things that you can do with permanent or whole life insurance that you can't do with term insurance. So the qualification is very similar though. Now let's take a look at permanent versus term insurance. Term insurance is really a short range product. I mean, it can go many years, but it only lasts for the term that you buy it. So you can buy a 10-year term, a 20-year term, a 30-year term insurance policy. And if you don't die within that term, the policy goes away, or you can renew the policy and you'll start to see the premiums very, very significantly increase from there. And I'll talk about that in a second. Permanent life insurance, and really permanent life insurance, there are a few types. You have whole life, of course, you have IUL, VUL, but if you really look at the details behind IUL and VUL, those are not true permanent products because they don't endow and they don't last and are not guaranteed to last as long as you live. So whole life insurance is really the only true permanent life insurance product on the market. So let's look at price, right? So most people are very familiar with term insurance. The price on term insurance is very low. The original term insurance used to be an annually renewing or annually increasing term insurance. So as you get older, of course, the cost of insurance goes up. And so what term insurance policies used to look like is every year the premium would go up a little bit. And as you get older, you start to get into that hockey stick area and the premium starts to increase more and more significantly as you get older. At some point, they developed a product called level term insurance which is what most of us are used to today. And that's, you pay the exact same premium for the entire term of the policy. However, what's not understood is when that term is done, you either give up the policy altogether, or if you do want to keep it, the premiums increase drastically. So for example, you could go from paying $1,000 a year for a term insurance premium, and after that level premium term is done, it could start getting up into like $15,000, $100,000 a year, believe it or not. So when we look at term insurance, the premiums start low, and over that first 30 years, and that's about as long as you can get a term insurance policy. Once that term's up, you see the premiums go like this. And so they just shoot up. It's really pretty unbelievable. And, give me a call sometime and I'll show you how that happens. But so that's what happens with term insurance. And a lot of people enjoy term because of this phase right here where the premiums are very low. Permanent insurance, on the other hand, the premiums are much higher, like 10 times higher. So it's significant. But the premiums, and I'm just going to refer to whole life insurance from here on out. I'm not talking about any of the other permanent insurance because those premiums can change depending on the product. But with whole life insurance, you're going to pay the exact same premium for your entire life. And just understand that there are ways to stop paying a premium and keep the policy in force. But the premium is going to stay the same the entire time you pay the premium. and the policy lasts your whole life. So it's guaranteed to pay the death benefit when you die, not if you die during a term. And so these premiums look more like this, and they'll last much, much longer than a term policy, and they'll go out here. And so what ends up happening is there's a guaranteed payout in the form of a death benefit. And what this is a guaranteed future cash flow. Because this is a guaranteed future cash flow, this policy that's a future value. If that's guaranteed, then there's a present value associated to that. So I would actually, instead of making these premiums red, I would actually make these green, because what you're doing is you're buying an asset. Term insurance is more of like a bill or a liability, so it's a true cost unless you happen to die during the term. By the way, less than 1% of term insurance policies pay the death benefit because they're no longer needed or they can't, or they're no longer affordable. Whereas permanent policies, a much higher percentage of those pay out, and there's a guaranteed payout at the end of everything. And so you're buying an asset. So let's talk about assets. Let's talk about asset classes. So here's something interesting. What are the different asset classes out there? We have cash, we have CDs, which is basically kind of like cash treasuries, right? We have stocks, we have bonds, we have real estate, we have businesses, and we have life insurance. Life insurance is just another asset class. There's a lot of to-do and, really strong opinions about life insurance. And it's just kind of funny to me because they're just making a big fuss over nothing. It's just another type of asset. And just like cash has its place, CDs have its place, stocks have its place, bonds, real estate, businesses, these all have their place in someone's financial life. Guess what? So does life insurance. It's just another asset class that you can combine with everything else that you're doing. The thing I want to kind of get across is, how does this asset class work? Believe it or not, whole life insurance is probably actually the most similar to real estate in the way that it can be used. From a performance and safety perspective, it's the closest to cash. So it's truly a cash asset, but the strategies that can be used with whole life insurance actually make it look a lot like real estate. And let me explain why. So with real estate, we pay a mortgage. That's a cash flow that goes into, paying for this house. And every time we make a mortgage payment, we build equity in the house or the real estate. In this case, the asset equals the real estate. And with that equity, we can go to a bank and get a home equity line of credit or a HELOC, and we can actually get access to that equity and get some leverage where we can deploy the money value of that equity. We can deploy that to go out and buy other assets or pay for large expenses or whatever we need to do. So everyone's pretty familiar with this. Lots of people pay mortgages, make mortgage payments. We make mortgage payments. We build equity in the asset that is real estate. And then we can go to a bank and get a line of credit against that equity and deploy that capital to some other endeavor. Well, believe it or not, life insurance is very much the same. Instead of a mortgage payment, we're making premium payments. The asset here is the death benefit, that future cash flow. Every time we make a premium payment, we build equity in the death benefit. That's called cash value. Did you know that cash value is nothing more than the equity in the death benefit? So a lot of people don't understand that. And if you do, it kind of changes how we look at whole life insurance policies. You can't have cash value without the death benefit. It's just the equity in your death benefit, or the present value of that future death benefit, the future cash flow. Just like the real estate, we can go to the life insurance company and get a policy loan similar to a HELOC. It actually works very similarly. It's just a line of credit, and that gives us access to the money value of that equity that we can deploy to go do something else. Very, very similar. The difference between a HELOC and a policy loan, though, there are pretty significant differences. We have guarantees around the policy loan. Flashback to COVID 2020, Wells Fargo started closing down some of their lines of credit. If you're in a place where you need to tap an asset to get equity and to get cash liquidity from that asset, imagine having to go to a bank and applying to get a line of credit against that equity. You have to show them all your financials. You have to get the permission of a bank to tap this equity. You don't have to do that with a policy loan. It's already collateralized by the cash value of your policy, or thus the death benefit. There's no questions asked. You don't have to apply. So there's no application. And you can get access to this cash. Can't be called, no calls. Unlike, just depends on the terms of your HELOC, but you can't, the policy loans can't be called. Guess what else? No payback terms. Everything's collateralized by the death benefit of the policy. So you can pay this loan back whenever you want, or never at all. What would happen is, if you didn't pay it back when you die and the death benefit is paid, they would just net the difference out and your beneficiary would receive the difference. Compare that to not making a mortgage or loan repayment on your house. You can get into foreclosures and lose that asset altogether. This doesn't happen here. You can have that happen if the loan does capitalize and exceeds the value of the cash value of the policy. But as long as that doesn't happen, this policy will remain in force even with a loan outstanding, for as long as the policy survives. So no payback terms, and I think that's the main gist of it. There might be one more that I'm not thinking of right now. But this is kind of, what we're getting at with a whole life insurance policy. Everyone's familiar with the qualifications. It's the same as term insurance. The difference between term and permanent, the permanent insurance premiums are way higher than term insurance during a typical term. But then once the term is over, these premium prices shoot up and they become way higher than permanent. So you can almost look at permanent insurance or whole life insurance as a 100-year level term insurance policy that builds cash value and has a guaranteed death benefit at the end of it. That guaranteed payout at the end, the guaranteed death benefit, creates a present value, or allows us to build equity in that death benefit that we can tap just like a HELOC, but on safer and better terms. And then remember, all the hubbub out there about, life insurance, lots of opinions. It all boils down to the fact that all life insurance is another asset class that has its own unique features, and they're very unique and special because it's all based on actuarial science. So life insurance can do some things that no other asset class can do because we have the actuarial data to create guarantees along with very respectable growth. So I hope this helps as a quick 101 crash course on where whole life sort of fits in the spectrum. If you have any questions, feel free to drop it in the comments, or feel free to also click the link and schedule a 30-minute consultation with me, and we can walk through how this might work in your life specifically. Thanks.